The quiet moment before the drop asterisk asterisk, there was no panic in the headlines, no emergency meetings announced on television, no sudden warning bells that ordinary people could hear. From the outside, everything looked steady. Markets were still opening and closing on schedule. Prices were moving, as they always do. Commentators were focused on the usual distractions: interest rates, elections, short-term data points that felt important but rarely explained much. For most observers, silver was just another line on a chart, quietly fluctuating in the background of a much larger financial picture. But beneath that calm surface, pressure was building. Not the kind of pressure that comes from public fear, but the quieter kind, the type that forms inside balance sheets, margin requirements, and obligations that cannot be postponed. Large institutions were not worried about headlines. They were focused on something far more basic: access to funding, access to breathing room, access to time. In moments like these, markets behave differently. Prices stop being signals of value and start becoming tools. Assets are no longer held because they are trusted, but because they can be used quickly, efficiently, and without drawing attention. Silver sat quietly in that space. It was liquid enough to move, familiar enough to ignore, old enough to feel stable, yet modern enough to exist mostly as numbers rather than metal. It did not carry the emotional weight of gold, nor the political sensitivity of currencies. For decades, it had lived in the background, important, but rarely central. That made it useful. When liquidity tightens, institutions do not look for fairness. They look for relief. They look for places where pressure can be released without causing visible damage elsewhere. And often, that means acting before anyone outside the system realizes something is wrong. Nothing dramatic happens at first. There is no single moment that can be pointed to and labeled as the beginning. Instead, small decisions accumulate, positions are adjusted, exposure is reduced. Risk managers start thinking less about profit and more about stability. Silver begins to feel heavier on the books, not because its fundamentals have changed, but because its role has. What was once a neutral holding becomes a potential source of cash, margin relief, or collateral flexibility. And in a system built on leverage, even small adjustments can ripple outward faster than expected. From the outside, it still looks normal. Charts show movement, but not meaning. Analysts debate supply and demand. Commentators offer explanations that sound reasonable enough. Few people stop to ask a deeper question: why now? Because the timing matters. These moments do not occur when systems are strong. They appear when systems are tight, stretched, and quietly negotiating with their own limits. Liquidity does not disappear suddenly, it thins. And when it does, assets that can be converted quickly become pressure points. Silver was one of them. This is not about villains or secret meetings. It is about priorities. When survival becomes the priority, transparency fades naturally. Decisions are made efficiently, not openly. The goal is not to convince anyone, it is simply to stabilize what must be stabilized. The drop, when it comes, feels abrupt only to those who are not watching the pressure build. To those inside the system, it feels almost inevitable. By the end of this moment, this quiet, unnoticed phase, something important has already happened. A line has been crossed, not in public, but in purpose. Silver is no longer just a market. It has become a mechanism, and once an asset becomes a mechanism, its price stops telling a story about value and starts telling a story about need. Liquidity is not cash, it is survival asterisk asterisk. Liquidity is often misunderstood because it sounds simple. Most people hear the word and think of cash money sitting safely, ready to be used. But inside large financial systems, liquidity means something very different. It is not comfort. It is not profit. It is not even wealth. Liquidity is survival. For institutions operating at scale, liquidity is the ability to meet obligations on time, under any conditions, without forcing visible damage elsewhere. It is the space between stability and stress, between control and reaction, and when that space narrows, priorities shift quietly but decisively. At that level, assets are not judged by what they are worth in theory. They are judged by how quickly they can be turned into flexibility, how efficiently they can reduce pressure, how easily they can satisfy requirements that do not wait for explanations. This is where the difference between value and usefulness becomes clear. An asset can be valuable and still be a problem if it cannot move fast enough. It can be trusted and still be expendable if it introduces friction at the wrong moment. In periods of tightening conditions, institutions do not ask which assets they believe in. They ask which ones can help them breathe. Liquidity shortages rarely announce themselves. They show up as small constraints, slightly higher margins, less favorable funding terms, tighter collateral rules. None of these feel dramatic on their own, but together they create a quiet urgency that reshapes decision-making. In these moments, time becomes the most expensive commodity of all. Selling something slowly is not an option. Waiting for the perfect price is not a luxury. What matters is certainty, the certainty that obligations will be met without hesitation, without explanation, and without drawing attention. Silver fits neatly into this reality. It exists in deep, active markets. It can be moved in size without immediate scrutiny, and perhaps most importantly, much of it exists as paper claims rather than physical metal. That distinction allows adjustments to happen quickly, cleanly, and at scale. From the outside, this still looks like ordinary market activity. Prices move, volatility appears. Analysts search for causes that fit familiar narratives. But inside the system, the reasoning is far simpler. Liquidity, pressure, demands release. Assets capable of providing that release are used. This is not emotional. It is procedural. Large institutions do not need silver to collapse. They need it to move. They need it to provide margin relief, collateral flexibility, or balance sheet adjustment at the exact moment it is required. The direction of the move matters less than the effect it produces. And when many participants face similar pressures at the same time, actions align naturally not through coordination, but through shared constraints. What emerges is not chaos, but pattern. Prices respond not to changing beliefs about the future, but to immediate needs in the present. The market begins to reflect internal stress rather than external reality. And because this process happens quietly, without announcements or warnings, it is often misunderstood after the fact. People search for news. They look for explanations. They assume something new must have happened. But often, nothing new occurred at all. What changed was the margin for error. By the end of this section, one idea becomes clear. The silver move was not about silver. It was about liquidity and the system's instinct to protect itself first, explain later. With that understanding in place, the next question becomes unavoidable. If liquidity pressure required a release, and silver provided it, then silver was not chosen by accident. Silver's unique position in the financial system, silver, occupies a strange position in the modern financial system. It is old, familiar, and deeply rooted in history, yet rarely treated with the seriousness of assets that share its past. It has been money, metal, technology, and commodity, sometimes all at once, and because it never fully settled into one role, it remains misunderstood. That misunderstanding is not accidental. Unlike gold, silver does not carry the same symbolic weight. It is not held up as a reserve asset on central bank balance sheets. It is not spoken about in speeches or defended publicly. It moves quietly, often framed as industrial input one moment and speculative trade the next. This ambiguity is precisely what makes it useful. Silver trades in deep markets with constant activity and global participation. It is liquid enough to absorb large moves without immediate disruption, yet small enough to avoid political attention. When its price shifts, few people ask whether the system itself is under strain. They assume something ordinary is at work: supply, demand, sentiment, but silver's structure tells a different story. Much of the silver market exists not as physical metal changing hands, but as promises, contracts, derivatives, claims layered on top of one another. This allows silver to function as a financial instrument more than a tangible asset. Exposure can be increased or reduced rapidly without trucks, vaults, or delays. in moments of stress, that flexibility matters more than purity or permanence. Silver also sits at a psychological midpoint. It is familiar enough to be trusted, but not sacred enough to be protected. Gold is watched closely, currencies are defended, equities draw headlines. Silver, by contrast, can move sharply with little explanation and even less resistance. That makes it adaptable. Institutions understand this, even if they never say it aloud. They know which markets tolerate pressure and which do not. They know where liquidity can be extracted without triggering broader concern. Silver has proven, again and again, that it can absorb strain quietly. This is not about manipulation in the dramatic sense. It is about structure. When stress enters the system, assets are evaluated based on how they behave under pressure. Silver has a long history of responding predictably. It can be pushed, leaned on, and adjusted without destabilizing the narrative of stability elsewhere. That reliability becomes valuable. Over time, patterns form. Silver tends to weaken during periods when liquidity is needed most, not because its fundamentals suddenly worsen, but because its position allows it to be used. It becomes a buffer, a shock absorber, a place where financial tension can dissipate. To most observers, this looks random. Prices fall when they shouldn't. Recoveries stall without obvious cause. The explanations offered feel incomplete because they are. They focus on surface-level drivers while ignoring deeper mechanics. But for those watching structure rather than headlines, the behavior makes sense. Silver is not being judged, it is being deployed. By understanding silver's unique role, liquid, flexible, overlooked, the listener begins to see why it so often appears at the center of these quiet adjustments. Not because it is weak, but because it is convenient. And once that realization settles in, the next layer becomes unavoidable. If silver's price can be influenced without moving the metal itself, if exposure can be shifted faster than reality, then the real story is not silver at all. It is the paper system built around it. Paper markets, pressure points, and silent control ***. Most people imagine commodities as physical things. Metal pulled from the ground, stored, transported, and eventually used. But in modern finance, the physical object is often the least important part of the market. What matters is the paper built around it. Silver is no exception. For every ounce of physical silver, there are layers of contracts, agreements, and claims that reference it without ever requiring delivery. These paper instruments are efficient. They allow institutions to gain exposure, hedge risk, or adjust positions instantly. They also allow scale, far more scale than the physical market could ever support on its own. This creates a quiet imbalance. Price discovery no longer reflects metal changing hands. It reflects positioning, leverage, and timing within paper systems. Movements can be sharp, sudden, and disconnected from physical reality, not because the market is broken, but because it is functioning as designed. During periods of calm, this structure feels invisible. Prices move within expected ranges. Participants trust that the system will work when needed, but when pressure builds, when liquidity tightens, these same structures become tools. Paper markets can be expanded or contracted with precision. Positions can be unwound quickly. Margin requirements can be met. Collateral can be freed, all without touching a single bar of silver. The market responds immediately, even if the underlying reality has not changed. This is where silent control appears, not in the form of orders given or rules broken, but through incentives and constraints. When multiple institutions face similar pressures, they act in similar ways. They reduce exposure where it is easiest. They lean on markets that allow it. Silver's paper, heavy structure makes it especially responsive to this behavior. The result looks like a coordinated move, even when it is not. Price falls create further margin pressure, encouraging more adjustments. Momentum builds not from belief, but from necessity. The system feeds on its own mechanics, amplifying moves that began as simple risk management decisions. To the outside world, explanations arrive late. Analysts talk about sentiment shifts or speculative excess. Commentators debate whether silver was overvalued. These narratives help fill the silence, but they do not explain the timing or the scale. What actually happened is quieter. The market absorbed stress where it could. Silver became a pressure point because it was built to be won. Its paper structure allows rapid response without friction. Its size allows movement without headlines. Its history allows the story to pass without challenge. This does not mean the system is unstable. It means it is adaptive. When liquidity is needed, the system does not ask permission. It uses the tools available. Paper markets exist precisely for this reason, to allow adjustment without disruption. By the end of this section, the listener understands something essential. Silver did not fail. It performed a function. It absorbed pressure so that other parts of the system did not have to. And once that idea settles, the focus naturally shifts. If markets reveal priorities, if pressure is released selectively. Then, what does this episode quietly say about what the system values most? That question does not need to be answered directly. When markets reveal priorities, markets speak most clearly when they are under pressure. Not through words or announcements, but through choices. What moves, what holds, and what absorbs stress all reveal priorities that are rarely stated openly. In this case, silver did not move because it lost relevance. It moved because it was allowed to. That distinction matters. When systems are strained, they protect what they must and use what they can. The result is not chaos, but a quiet hierarchy of importance. Some assets are defended instinctively. They are central to confidence, stability, or narrative control. Others are permitted to fluctuate, even sharply, because their movement does not threaten the larger structure. Silver falls into this second category. This is not a judgment, it is a function. By watching where pressure is released, the listener begins to understand what the system values most. Stability over price integrity. Continuity over explanation. Order over transparency. These priorities are not hidden, they are simply expressed through action rather than language. The silver move becomes a signal, not a signal about silver itself, but about the conditions surrounding it. Liquidity mattered more than price. Flexibility mattered more than fairness. The ability to respond quickly mattered more than maintaining appearances. This realization does not need to provoke concern. It invites clarity. Financial systems are not moral structures, they are mechanical ones. They respond to constraints and incentives with precision, not intention. When stress appears, they do not pause to consider optics. They solve the problem in the most efficient way available. Silver was efficient. As this understanding settles, the listener may notice something else. These moments are rarely isolated. They appear in cycles, repeating across decades and asset classes. The specific market changes, but the behavior remains familiar. Pressure builds quietly, liquidity tightens, a flexible asset absorbs the strain. The pattern is not hidden, but it is often overlooked because it unfolds without drama. By the end of this section, the listener connects the dots on their own. There is no need for conclusions or warnings. The system revealed itself through action, and that revelation is enough. The calm that emerges is not comfort, it is orientation. A sense of knowing where one is standing and how the ground tends to move beneath the surface. With that perspective in place, the final section does not need to explain what comes next. It only needs to leave the understanding where it belongs, quietly active in the listener's mind. A system that solves problems quietly ***. The most effective systems do not announce their solutions. They apply them. By the time a move becomes visible on a chart, the problem it addressed has often already passed. The urgency that required action has been absorbed, diffused, and replaced by the appearance of normality. Life goes on. Markets continue. Attention shifts elsewhere. This is how stability is maintained. The silver crash did not arrive with an explanation because it did not require one. It was not meant to persuade, warn, or inform. It was meant to function, and once that function was served, the system returned to its usual rhythm. Nothing was fixed in a permanent sense. Pressure was simply managed. This distinction matters. Systems built for continuity do not aim for resolution. They aim for time, time to roll obligations forward, time to let conditions change, time to allow tension to disperse without confronting its source directly. Silver provided that time. Its movement created space on balance sheets, in margin calculations, within collateral frameworks that few people ever see. The effect was real, even if the cause was never discussed, and because the adjustment occurred in a market accustomed to volatility, it did not disturb confidence elsewhere. From the listener's perspective, this realization feels complete, but not closed. There is no final message being delivered, no instruction to act, no urgency to respond, only an understanding that what appeared sudden was, in fact, part of a familiar process. Once you recognize this pattern, it becomes difficult to unsee. Not just in silver, but across markets. Different assets take on the role at different times. Sometimes it is a currency, sometimes a bond market, sometimes a commodity that sits just far enough from attention to move without resistance. The names change, the function does not. This does not mean every price move hides a deeper motive. It means that when pressure appears, solutions tend to look similar. They are quiet, efficient, and temporary. They leave behind charts and questions, but rarely explanations. That is not a flaw in the system. It is a feature. By ending here, the story does not resolve itself with answers. It resolves itself with perspective. The listener is left not with concern, but with awareness, a calm recognition of how problems are handled when they must be handled quickly. Silver was not the headline, liquidity was, and somewhere, long after attention moved on, the system did what it always does. It kept going,